Welcome to this audiobook on understanding the impact of interest rate changes on your portfolio. Whether you're an experienced investor or just starting out, one of the most significant factors influencing your investment returns is the change in interest rates. Interest rates can shape the economic environment, affect how much you pay for loans, and have a profound effect on the performance of your investments. Understanding these impacts is key to making smart financial decisions and positioning your portfolio for long-term growth. Interest rates set by central banks like the Federal Reserve in the U.S. are a reflection of the cost of borrowing money. When interest rates rise or fall, they influence the broader economy, including the bond market, stock market, real estate, and even the value of the dollar. As an investor, these fluctuations can either enhance or hinder your portfolio's performance, making it essential to understand how these changes work and how you can adapt your strategy. Interest rate changes, while often gradual, can have immediate and long-lasting effects on your investments. For example, when interest rates rise, bond prices tend to fall, while certain stocks, especially those in interest-sensitive sectors like utilities and real estate, can also feel the pressure. On the other hand, lower interest rates often drive growth in the stock market, particularly in sectors that rely on borrowing for expansion. How your portfolio reacts depends largely on the types of assets you hold and how exposed you are to changes in interest rates. This audiobook aims to give you a deeper understanding of how interest rate fluctuations affect various asset classes and provide actionable strategies to help you manage these changes effectively. We'll cover everything from the impact on stocks, bonds, and real estate to the implications for your overall investment strategy. You'll learn how to position your portfolio to benefit from interest rate changes, how to mitigate risks, and how to make informed decisions that support your long-term financial goals. As we explore the impact of interest rates on your portfolio, it's important to remember that no two market environments are the same. By staying informed and understanding how to adjust your strategy, you can navigate the complex world of interest rates with confidence and continue to build wealth over time. Let's dive in and start understanding how interest rate changes can impact your investments and what you can do to adapt. Chapter 1. What are interest rates and why do they matter? Before diving into how interest rate changes impact your portfolio, it's important to first understand what interest rates are and why they matter in the first place. Whether you're investing in stocks, bonds, or real estate, interest rates play a central role in determining the economic environment in which you're operating. In this chapter, we'll break down the concept of interest rates, how they are set, and why they have such a profound impact on investments. To begin, think of interest rates as the cost of borrowing money, or the return you receive on money you lend or save. They are expressed as a percentage and are determined by the interaction of supply and demand in the broader economy. In the simplest terms, when interest rates go up, borrowing becomes more expensive, which often leads to reduced spending and investing. Conversely, when interest rates go down, borrowing becomes cheaper, which tends to encourage spending and investment. Understanding the basic concept of interest rates. At their core, interest rates represent the cost of money. For example, if you borrow money, you are essentially paying a fee for using someone else's funds. This fee, known as interest, is expressed as a percentage of the loan amount. Let's say you borrow $1,000 from a bank at an annual interest rate of 5%. This means you would owe the bank $50 in interest for the year, in addition to repaying the $1,000 principal. Interest rates also apply to investments, where they can be viewed as the return on savings or the cost of capital. When you deposit money in a savings account or invest in bonds, you're essentially lending your money to an institution or government, and they compensate you with interest. In this case, interest is the return you receive for allowing someone else to use your money. How are interest rates set? Interest rates are influenced by multiple factors, but the most prominent driver is central banks, such as the Federal Reserve in the United States or the European Central Bank, ECB, in Europe. These institutions set benchmark interest rates, the rates at which they lend to commercial banks or other financial institutions. The federal funds rate, set by the Federal Reserve in the U.S., is one of the most significant rates in global financial markets. When the Federal Reserve raises or lowers this rate, it has a ripple effect across the entire economy, impacting everything from mortgage rates to car loans to business loans. The central bank adjusts interest rates to manage economic growth, control inflation, and stabilize the economy. When the economy is expanding too quickly and inflation begins to rise, central banks may increase interest rates to cool things down. Conversely, when the economy is struggling and inflation is low, central banks may lower rates to stimulate borrowing and spending. The role of interest rates in the economy. Interest rates play a critical role in shaping the broader economy. Their effects touch virtually every sector, from consumer spending to corporate investment to the housing market. Consumer spending. When interest rates are low, borrowing becomes cheaper for consumers. For example, a lower interest rate on a mortgage means lower monthly payments for home buyers, encouraging them to buy homes. Similarly, lower rates on car loans or credit cards may encourage consumers to spend more, stimulating economic activity. On the other hand, higher interest rates increase the cost of borrowing, leading consumers to scale back on spending, which can slow economic growth. Business investment. When businesses can borrow money at low interest rates, they are more likely to invest in expansion, innovation, and new projects. Lower borrowing costs make it more affordable to take on debt for buying equipment, hiring new employees, or expanding operations. Higher interest rates, however, can discourage businesses from borrowing, leading to slower growth and fewer investments. Inflation control. Central banks use interest rates as a tool to control inflation. When inflation is rising too quickly, central banks will often raise interest rates to make borrowing more expensive and reduce spending. By doing so, they hope to cool down the economy and stabilize prices. Conversely, when inflation is low or the economy is slowing, central banks may lower interest rates to encourage spending and investment. Types of interest rates: nominal versus real rates. Understanding the difference between nominal and real interest rates is crucial in analyzing how interest rates affect investments. Nominal interest rate. This is the interest rate that is advertised or quoted by financial institutions. It represents the amount of interest paid or earned on a loan or investment without adjusting for inflation. For example, if you have a 5% savings account interest rate, this is the nominal rate. Real interest rate. The real interest rate adjusts the nominal rate to account for inflation. Inflation erodes the purchasing power of money over time, so a nominal interest rate of 5% may not be as attractive if inflation is running at 3%. The real interest rate is calculated by subtracting the inflation rate from the nominal rate. In this case, the real interest rate would be only 2%, 5% nominal rate, minus 3% inflation rate. The real interest rate is a more accurate measure of the purchasing power of your investment returns. For example, if you're investing in a bond that offers a 6% annual return, but inflation is at 2%, the real return you are getting is only 4%. This shows how inflation impacts the value of your investment returns. Interest rates and the bond market. One of the most direct relationships between interest rates and asset prices is found in the bond market. Bonds are essentially loans that you make to governments or corporations, and they pay you interest over time. The bond price moves inversely with interest rates. This means that when interest rates rise, bond prices fall, and when interest rates fall, bond prices rise. When interest rates rise, newly issued bonds offer higher yields, the return on investment, to attract buyers, which makes older bonds with lower yields less attractive. Consequently, the prices of older bonds decline to match the yields of new bonds. On the flip side, when interest rates fall, older bonds with higher yields become more attractive and their prices rise. For investors, this relationship means that bond prices and interest rates are inversely correlated. If you hold long-term bonds in a rising interest rate environment, the value of your bonds may decrease. Understanding this dynamic is important, especially for investors with a significant portion of their portfolio in fixed income assets. Interest rates and the stock market. Interest rates also affect stock prices, though in a more indirect manner. Rising interest rates typically signal that the central bank is trying to control inflation or slow down an overheating economy. As a result, higher rates can make borrowing more expensive for businesses, potentially reducing their profitability. In a rising interest rate environment, investors may seek safer assets like bonds, which now offer higher yields. This shift can lead to lower demand for stocks, especially for growth stocks, which rely on cheap borrowing to fund their expansion. Growth stocks, particularly in sectors like technology, may be particularly sensitive to higher interest rates because higher borrowing costs reduce future earnings projections. Conversely, when interest rates are low, borrowing costs are also low, which can encourage businesses to invest and expand. Lower interest rates make stocks more attractive relative to bonds, driving up stock prices and stimulating economic activity. In general, the impact of interest rate changes on the stock market varies depending on the type of stock, the health of the economy, and investor sentiment. Defensive sectors like utilities, consumer staples, and healthcare tend to be more resilient in higher interest rate environments, while cyclical stocks, such as those in the consumer discretionary and technology sectors, are more sensitive to changes in interest rates. Interest rates and real estate. The real estate market is particularly sensitive to interest rate changes, especially when it comes to mortgages. When interest rates rise, the cost of borrowing to finance a home or real estate investment increases, making it more expensive to purchase property. This can slow down demand in the housing market, leading to a cooling effect on home prices. For real estate investors, higher interest rates can increase the cost of financing properties, potentially reducing the profitability of new investments or making it harder to secure financing. However, some real estate investment vehicles, such as real estate investment trusts, REITs, may also face challenges during periods of rising interest rates, as higher borrowing costs can impact the profitability of underlying real estate investments. On the flip side, when interest rates are low, mortgage rates tend to be lower, encouraging more people to buy homes and fueling demand in the housing market. This can lead to higher property prices and increased opportunities for real estate investors. Conclusion: the importance of interest rate awareness for investors. Interest rates are one of the most significant factors influencing the performance of your investments. Whether you're invested in stocks, bonds, real estate, or other assets, interest rate changes can affect your returns in various ways. Rising interest rates generally make borrowing more expensive, leading to reduced spending and investment, while lower rates tend to stimulate economic activity by making borrowing more affordable. As an investor, understanding the dynamics of interest rates and their impact on different asset classes is essential for making informed decisions. By keeping an eye on interest rate trends and adjusting your investment strategy accordingly, you can better position your portfolio to withstand volatility, reduce risks, and capitalize on opportunities that arise during different interest rate environments. In the next chapter, we'll dive deeper into how interest rate changes specifically impact stocks, bonds, and real estate, and explore strategies you can use to protect and grow your portfolio in the face of these fluctuations. By the end of this audiobook, you'll be well equipped with the tools to navigate interest rate changes with confidence, ensuring your portfolio continues to thrive regardless of what the future holds. Chapter 2: How interest rates affect different asset classes. Interest rates are one of the most important drivers of financial markets and can have far-reaching effects on a wide variety of asset classes. The way that interest rate changes influence the prices of stocks, bonds, real estate, and other investments can be a critical factor in your portfolio's performance. Understanding how different asset classes respond to changes in interest rates is crucial for any investor, whether you're managing your own retirement portfolio or looking to build wealth over time. In this chapter, we will break down the specific impacts of interest rates on several major asset classes. We will look at the dynamics of how stocks, bonds, and real estate react to interest rate changes and explore the factors that drive these relationships. By the end of this chapter, you'll have a comprehensive understanding of how interest rate fluctuations can either help or hurt the different components of your investment portfolio. 1. Bonds, the most sensitive asset class to interest rates. Bonds are perhaps the most directly affected asset class when it comes to interest rate changes. A bond is essentially a loan you make to a government or corporation in exchange for periodic interest payments and the return of your principal at maturity. The coupon rate on the bond represents the fixed interest payment, but its price can fluctuate depending on changes in market interest rates. Inverse relationship between bonds and interest rates. The key thing to understand about bonds is that they have an inverse relationship with interest rates. This means that when interest rates rise, bond prices tend to fall, and when interest rates fall, bond prices tend to rise. Here's why. When interest rates rise, newly issued bonds offer higher coupon rates, making them more attractive than older bonds with lower rates. As a result, the demand for older bonds decreases, causing their prices to drop. When interest rates fall, newly issued bonds offer lower coupon rates, making older bonds with higher rates more attractive. As a result, the demand for older bonds increases, and their prices rise. How duration affects bond sensitivity to interest rates. The impact of interest rate changes on bond prices is also heavily influenced by the bond's duration. Duration measures a bond's sensitivity to interest rate changes. Generally, the longer the bond's maturity, the more sensitive it is to interest rate fluctuations. For example, a long-term bond with a maturity of 20 years will see a larger price drop when interest rates rise than a short-term bond with a maturity of 2 years. This is because long-term bonds lock in lower interest payments for a longer period, and therefore are more sensitive to the opportunity cost of investing in new bonds with higher rates. How to navigate rising interest rates with bonds. If you anticipate that interest rates will rise, one strategy to consider is reducing your exposure to long-term bonds and shifting to short-term bonds or bonds with floating rates. Short-term bonds are less sensitive to interest rate changes because they mature more quickly, allowing you to reinvest in higher-yielding bonds sooner. Floating-rate bonds, which adjust their coupon rates with changes in interest rates, can also be a good way to protect yourself from rising rates. 2. Stocks, the indirect impact of interest rates. While stocks are not as directly influenced by interest rate changes as bonds, interest rates still have a significant impact on stock prices. The relationship between stocks and interest rates is more indirect but is nonetheless critical to understand for managing your portfolio. Higher interest rates, the pressure on growth stocks. When interest rates rise, the cost of borrowing increases for businesses. Companies that rely on debt to fund expansion, growth, and innovation may find it more expensive to borrow capital. This can slow down their growth and reduce profitability, leading to lower stock prices. Growth stocks, in particular, are especially sensitive to rising interest rates. These stocks represent companies that are expected to grow rapidly and reinvest their profits to fuel future growth, rather than paying dividends. Higher borrowing costs make it more difficult for these companies to fund their expansion, which can lower their future earnings and stock price. Tech companies, for instance, often rely heavily on cheap capital to fuel their growth. When interest rates rise, their borrowing costs increase, which could hurt their profitability and stock valuations. This explains why technology stocks tend to underperform when rates are rising. Lower interest rates, stimulating growth and investment. Conversely, when interest rates fall, borrowing becomes cheaper. This creates an environment where companies can borrow more easily to invest in new projects, expand operations, or acquire other businesses. As a result, stocks, especially those of growth companies, tend to rise when interest rates are low. This is because lower rates make borrowing less expensive, encouraging investment and expansion. In addition, when rates are low, bonds become less attractive to investors because the yields are lower. As a result, investors may shift their capital into stocks, increasing demand and driving stock prices up. Dividend stocks, the favorable impact of lower interest rates. One sector of the stock market that is more resilient in a low interest rate environment is dividend stocks. Dividend-paying stocks, such as those in the utilities, consumer staples, and real estate sectors, become more attractive when interest rates are low because they offer stable, regular income through dividends. These stocks are often viewed as income-generating alternatives to bonds, so when interest rates are low, investors may flock to them, driving their prices higher. However, in a rising interest rate environment, the appeal of these dividend-paying stocks diminishes somewhat, as they may not be able to offer competitive yields compared to newly issued bonds. 3. Real estate, sensitive to borrowing costs and economic conditions. Real estate is another asset class that is highly influenced by interest rates, particularly in terms of how they affect borrowing costs. Whether you're purchasing a home, investing in commercial real estate, or buying real estate investment trusts, REITs, interest rates play a critical role in determining real estate values and returns. Impact of rising interest rates on real estate. When interest rates rise, the cost of mortgages increases. Higher mortgage rates reduce the purchasing power of home buyers as monthly payments become more expensive. This leads to a slowdown in home sales, reducing demand for homes and putting downward pressure on home prices. For real estate investors, higher borrowing costs also make it more expensive to finance property purchases, which can reduce profitability. The commercial real estate market can also be negatively affected by higher interest rates. Businesses may face higher borrowing costs when trying to finance new buildings, leases, or expansions. This can reduce demand for commercial properties and cause a slowdown in the real estate market. Real estate investment trusts, REITs, and interest rates. Real estate investment trusts, REITs, are another avenue through which many investors gain exposure to real estate. REITs are companies that own, operate, or finance real estate, and they pay out a large portion of their income as dividends to investors. As interest rates rise, the cost of capital for REITs increases, which can hurt their profitability, particularly if they need to borrow to finance new acquisitions or developments. Furthermore, when interest rates rise, investors may shift away from REITs and other income-generating stocks to bonds, which may offer more attractive yields. How to navigate real estate in a changing rate environment. If you're a real estate investor or interested in REITs, it's important to keep a close eye on interest rate trends. During periods of rising rates, you may want to consider focusing on properties with fixed-rate loans, which are not as sensitive to changes in interest rates. For REITs, favor those with strong balance sheets and low debt levels, as they will be better positioned to withstand rising borrowing costs. Additionally, in periods of high rates, real estate investors can consider focusing on properties in high-demand areas or those offering stable cash flow, such as rental properties in prime locations. These properties may be more resilient in the face of rising rates due to their desirability and consistent income generation. 4. Alternative investments and interest rates. Beyond stocks, bonds, and real estate, there are many other alternative investments that can be impacted by interest rate changes. These include commodities, private equity, hedge funds, and cryptocurrencies. While these asset classes may not have as direct a relationship with interest rates as stocks and bonds, they still respond to changes in the broader economic environment influenced by interest rates. Commodities. Commodities, such as gold, oil, and agricultural products, tend to benefit from rising inflation, which can often be triggered by increasing interest rates. However, the relationship between interest rates and commodities can be complex. For example, when interest rates rise, the US dollar typically strengthens, which can put downward pressure on commodity prices, as commodities are often priced in dollars. Conversely, lower interest rates may lead to a weaker dollar, which can drive up commodity prices. Cryptocurrencies and emerging asset classes. Emerging asset classes like cryptocurrencies have a more complex relationship with interest rates. While still relatively new, the rise of cryptocurrencies like Bitcoin has created an asset class that some investors view as a store of value, similar to gold. Cryptocurrencies may not be as directly tied to interest rates, but they can be influenced by inflation expectations, monetary policy, and overall investor sentiment, all of which are affected by changes in interest rates. 5. The big picture: how interest rates shape the financial ecosystem. As we have seen throughout this chapter, interest rates affect virtually every aspect of the financial ecosystem. From the value of bonds to the performance of stocks and real estate, changes in interest rates can ripple through the markets, affecting how we save, invest, and plan for the future. By understanding how interest rates influence different asset classes, you can make more informed decisions about how to position your portfolio. In a low-rate environment, stocks, real estate, and other growth-oriented investments tend to perform better, while in a high-rate environment, more defensive investments like bonds and dividend-paying stocks may become more attractive. The key to managing your portfolio in the face of interest rate changes is adaptability. Stay informed about the broader economic environment, track interest rate movements, and be prepared to adjust your strategy as needed. Whether you're seeking growth, income, or capital preservation, understanding the impact of interest rates on your investments will help you navigate the changing landscape of the financial markets with confidence. Conclusion: adapting to interest rate fluctuations. Interest rates are one of the most influential factors affecting the performance of your investments. By understanding the relationship between interest rates and different asset classes, such as bonds, stocks, real estate, and commodities, you can better position your portfolio to weather fluctuations in the economy. The more informed you are about how these rate changes influence your investments, the more prepared you'll be to make strategic adjustments that maximize your long-term financial success. As we move forward in this audiobook, we'll explore specific strategies for managing your portfolio in the face of interest rate changes, including how to rebalance your investments and how to protect your wealth from rising rates. The next step is to take this knowledge and apply it to your portfolio, so you can thrive regardless of the interest rate environment. Chapter 3. The strategies for managing your portfolio during interest rate changes. Interest rate fluctuations are one of the most significant factors influencing the performance of your portfolio. As we explored in the previous chapters, interest rates can affect various asset classes, including stocks, bonds, real estate, and commodities. However, the key to successful investing is not merely understanding these impacts, but knowing how to adjust your portfolio in response to changes in the interest rate environment. In this chapter, we will explore several strategies for managing your investments during periods of interest rate changes. These strategies will help you optimize returns, mitigate risk, and preserve your capital during both rising and falling interest rate environments. By the end of this chapter, you'll be equipped with the tools you need to adapt to rate changes and position your portfolio for success. 1. Understanding your risk tolerance and time horizon. Before diving into specific strategies for managing your portfolio during interest rate changes, it's essential to first assess your risk tolerance and time horizon. These two factors will heavily influence how you react to interest rate fluctuations and what types of adjustments are most appropriate for you. Risk tolerance. Your risk tolerance is your ability and willingness to endure volatility and losses in your portfolio in exchange for the potential for higher returns. Risk tolerance is personal and can change depending on factors like age, financial goals, and your overall financial situation. For example, younger investors generally have a higher risk tolerance because they have more time to recover from potential losses. On the other hand, investors closer to retirement may have a lower risk tolerance and prefer safer investments that preserve capital. Time horizon. Your time horizon refers to how long you plan to keep your money invested before needing to access it. If you have a long time horizon, such as 20 or 30 years, you can afford to weather market fluctuations and focus on growth assets like stocks. However, if you are planning to retire in the next 5-10 years, your time horizon is shorter, and you may want to focus on more stable, income-generating investments. As interest rates change, understanding your risk tolerance and time horizon allows you to make adjustments that align with your investment goals. These factors help determine whether you should be more aggressive with your portfolio during rising rates or adopt a more defensive approach. 2. Adjusting bond allocations, duration and yield curve strategy. One of the most immediate impacts of interest rate changes is on your bond portfolio. As we've seen, bond prices have an inverse relationship with interest rates. When rates rise, bond prices generally fall, and when rates fall, bond prices rise. Therefore, managing your bond allocations is crucial during periods of interest rate changes. Shorten duration in a rising rate environment. When interest rates are expected to rise, one of the most effective strategies is to shorten the duration of your bond holdings. The duration of a bond measures its sensitivity to interest rate changes. The longer the duration of a bond, the more its price will drop when interest rates rise. For instance, a long-term bond with a 20-year maturity will likely see a more significant price drop than a short-term bond when interest rates rise. This is because long-term bonds lock in lower interest rates for a longer period, making them more vulnerable to the opportunity cost of higher-yielding bonds. By shifting your bond allocations to short-term bonds or floating-rate bonds, you can reduce the negative impact of rising interest rates. Short-term bonds are less sensitive to rate changes and tend to be more stable, providing you with steady returns while minimizing risk. Floating-rate bonds, which adjust their interest rates periodically, also offer protection against rising rates. Yield curve strategy. Another approach to bond management during interest rate changes is the yield curve strategy. The yield curve refers to the difference in interest rates between short-term and long-term bonds. In a typical interest rate environment, long-term bonds have higher yields than short-term bonds because investors expect more compensation for the longer duration of risk. However, when interest rates rise, the yield curve may flatten or even invert, meaning that short-term interest rates become higher than long-term rates. In such a scenario, you may want to adjust your portfolio to take advantage of short-term bond opportunities while avoiding the risks associated with long-term bonds. This strategy can provide more flexibility and help you capitalize on changing interest rates. 3. Adjusting stock allocations. Focus on sectors that thrive in rising rates. Stocks are not as directly affected by interest rate changes as bonds, but they are still impacted, especially in certain sectors. When interest rates rise, borrowing becomes more expensive for businesses, which can reduce corporate profits, slow down expansion, and lead to a drop in stock prices. Favor financial stocks. In a rising interest rate environment, one sector that tends to benefit is the financial sector, particularly banks and insurance companies. Banks typically profit from higher interest rates because they can charge more for loans and earn higher yields on their investments. As a result, they often perform well when rates rise. Insurance companies also benefit from rising rates because they hold large portfolios of bonds. When interest rates rise, the yield on new bonds increases, allowing insurance companies to earn more income from their investments. Defensive sectors. Another important aspect of managing your stock portfolio during periods of rising interest rates is understanding which sectors are more defensive. Defensive stocks, such as those in utilities, consumer staples, and healthcare, tend to be less sensitive to interest rate changes. These sectors provide goods and services that people need regardless of the economic environment, making them less affected by fluctuations in borrowing costs. In a rising interest rate environment, investors may seek stability in these sectors, which can lead to strong performance in utilities, healthcare, and consumer staples stocks, even if the broader market faces volatility. Growth versus value stocks. Interest rate changes can also impact growth stocks and value stocks differently. Growth stocks, particularly those in the technology sector, often depend on cheap borrowing to fund their expansion. When interest rates rise, growth stocks may experience a decline in their valuations, as higher borrowing costs reduce future growth prospects. On the other hand, value stocks typically found in sectors like energy, financials, and consumer goods tend to perform better in rising interest rate environments. These stocks often offer higher dividend yields and can be more attractive when interest rates increase, as they provide a more stable income stream compared to growth stocks. 4. Real estate. Adjusting your approach to property investments. Real estate is another asset class that is highly sensitive to interest rate changes. Rising interest rates increase the cost of borrowing, which can slow down the housing market and make real estate investments less profitable. However, there are strategies you can use to navigate these changes and protect your real estate investments. Refinance. Fixed-rate mortgages. If you are a real estate investor with properties financed through fixed-rate mortgages, rising interest rates can actually benefit you. With a fixed-rate mortgage, your borrowing costs remain stable regardless of what happens to interest rates in the market. If rates rise, you are shielded from higher borrowing costs because your rate is locked in for the life of the loan. On the other hand, if you are planning to buy new real estate or refinance existing properties, rising interest rates could make borrowing more expensive. To manage this, you might want to consider locking in low rates through fixed-rate mortgages before rates rise further. Focus on real estate sectors that are resilient to rate changes. When interest rates rise, certain types of real estate are more resilient than others. Commercial real estate in prime locations or sectors like industrial properties, for example, warehouses or distribution centers, tend to be more insulated from the effects of rising rates, especially if the demand for those properties remains strong. Multifamily properties, apartment buildings, can also perform well during periods of rising interest rates, as housing demand remains strong even if mortgage rates rise. On the other hand, retail and office spaces can be more vulnerable during periods of rising rates, as higher borrowing costs can reduce demand for new commercial real estate developments or make it more difficult for businesses to expand. Real estate investment trusts, REITs. Investing in REITs can be a good way to gain exposure to real estate while mitigating the risks associated with rising interest rates. However, it's important to understand that REITs may struggle in a higher rate environment because they often rely on borrowing to fund new property acquisitions and developments. As interest rates rise, the cost of financing increases, which can reduce the profitability of REITs. To manage the risks, consider focusing on REITs that focus on sectors with stronger demand during rising rates, such as industrial properties or multifamily housing. These REITs tend to perform better in a rising interest rate environment, as they are less reliant on new financing to grow their portfolios. 5. Diversification, a cornerstone of managing interest rate risk. Ultimately, one of the most effective strategies for managing the impact of interest rate changes on your portfolio is diversification. Diversification is the practice of spreading your investments across a variety of asset classes, industries, and geographical regions to reduce risk. By diversifying, you are less likely to be overly affected by adverse changes in one specific area of your portfolio. For example, if you are heavily invested in long-term bonds and interest rates rise, the value of your bonds will likely drop. However, if you have diversified your portfolio with stocks, real estate, and alternative assets, the impact of rising rates on your bond holdings may be cushioned by the performance of your other investments. Conclusion: stay flexible and adaptable to interest rate changes. Interest rate changes are a natural part of the financial landscape, and while they can present challenges, they also offer opportunities for those who are prepared. By understanding how interest rates affect different asset classes and implementing strategies such as adjusting your bond duration, reallocating stocks, and managing your real estate investments, you can better navigate rate changes and keep your portfolio on track. In the next chapter, we'll explore specific tools and resources for monitoring interest rate changes and how to stay ahead of market trends. With the right approach, you can not only protect your investments from the negative effects of rising interest rates, but also position yourself to capitalize on the opportunities that come with changing economic conditions. Chapter 4: Planning for the Future: How to Stay Ahead of Interest Rate Trends. Interest rates are one of the most powerful forces shaping the financial markets. Their impact is felt across all asset classes, including bonds, stocks, real estate, and commodities. As we've seen in previous chapters, interest rate fluctuations can significantly affect the performance of your portfolio. However, the key to successfully managing your investments during periods of rate changes lies in being proactive rather than reactive. The most successful investors are those who can anticipate interest rate trends and adjust their strategies accordingly. In this chapter, we will explore strategies to help you stay ahead of interest rate trends and plan for the future, ensuring that your portfolio remains resilient and poised for growth, regardless of the economic climate. 1. Understanding the economic indicators that signal interest rate changes. The first step in staying ahead of interest rate trends is to understand the economic indicators that influence rate decisions. Central banks, such as the Federal Reserve in the U.S., adjust interest rates based on economic conditions, particularly inflation, economic growth, and employment. By closely monitoring these indicators, you can better anticipate whether interest rates are likely to rise or fall and take proactive steps to adjust your portfolio accordingly. Inflation. One of the primary factors driving interest rate changes is inflation. Inflation refers to the increase in the price of goods and services over time, which erodes the purchasing power of money. Central banks typically raise interest rates when inflation is high to cool down an overheating economy and prevent prices from rising too quickly. Conversely, they lower rates when inflation is low or when economic growth is sluggish. Monitoring inflation reports such as the Consumer Price Index (CPI) can help you anticipate future rate hikes or cuts. If inflation is consistently rising, it may signal that the central bank will raise interest rates to combat inflationary pressures. On the other hand, if inflation is under control, the central bank may opt to keep rates low to encourage borrowing and investment. Economic growth and GDP. Another important indicator of potential interest rate changes is economic growth, often measured by gross domestic product, GDP. When the economy is growing at a healthy pace, there may be upward pressure on inflation as demand for goods and services increases. To counteract this, central banks may decide to raise interest rates to prevent the economy from overheating. Conversely, if economic growth slows down or enters a recessionary phase, the central bank may lower interest rates to stimulate spending and investment. Paying attention to GDP growth rates and other economic indicators, such as consumer spending, business investment, and consumer confidence, can give you valuable insights into the likely direction of interest rates. Employment data. The central bank also closely monitors employment data to gauge the health of the economy. Low unemployment and strong job growth are signs of a thriving economy. But they can also lead to inflationary pressures as businesses compete for workers and wages rise. To curb this, the central bank may raise interest rates to prevent the economy from overheating. Conversely, high unemployment or a slowdown in job creation can prompt the central bank to lower interest rates to stimulate economic activity. Monitoring employment reports, such as the monthly jobs report and the unemployment rate, can give you a sense of whether interest rates are likely to rise or fall. 2. Diversifying your portfolio to weather interest rate volatility. One of the most important strategies for staying ahead of interest rate trends is diversification. Diversifying your investments across different asset classes, sectors, and geographical regions helps reduce the impact of any one economic factor, including interest rates. By having a well-diversified portfolio, you can better weather the volatility that often comes with changing interest rates and increase your chances of long-term success. Stocks tilt towards sectors that thrive in rising rates. When interest rates rise, certain sectors of the stock market may underperform, while others may benefit. To stay ahead of interest rate trends, it's important to tilt your stock allocations towards sectors that are less sensitive to rate changes or that actually benefit from rising rates. For example, financial stocks, such as banks, insurance companies, and investment firms, often perform well in rising interest rate environments. Higher interest rates increase the profits of banks by allowing them to charge higher interest rates on loans and earn higher yields on their investments. On the other hand, sectors such as real estate, utilities, and consumer staples may struggle when interest rates rise, as they are more sensitive to higher borrowing costs. By rotating into sectors like financials and energy, you can potentially position your portfolio for success in a rising interest rate environment. Bonds. Shorten duration and use inflation-protected bonds. As discussed earlier, bonds are particularly sensitive to interest rate changes. When rates rise, bond prices fall, which can negatively affect your bond portfolio. To manage this risk, one effective strategy is to shorten the duration of your bond holdings. Short-duration bonds are less sensitive to interest rate changes, and they allow you to reinvest more quickly in higher-yielding bonds as rates rise. In addition, consider investing in inflation-protected bonds, such as Treasury inflation-protected securities, TIPS. These bonds are designed to adjust their principal value with inflation, ensuring that your investment keeps pace with rising prices, even if interest rates are increasing. Real estate. Focus on high-quality, income-producing properties. For real estate investors, managing interest rate risk involves a careful selection of properties and financing structures. Rising interest rates make it more expensive to finance property purchases, which can lead to reduced demand and lower property values. However, certain types of real estate may be more resilient to rate changes, particularly properties in prime locations or those that generate strong cash flow. Consider focusing on income-producing properties, such as rental real estate or commercial properties with long-term leases. These types of properties can provide a steady stream of income, which may help cushion the impact of rising interest rates. Additionally, real estate investment trusts, REITs, that focus on properties with fixed-rate debt and strong cash flow can be a good hedge against rising rates. 3. Timing and rebalancing. Adapting to changing conditions. Interest rates can fluctuate over time, and adapting your investment strategy to these changes is crucial. Regular rebalancing ensures that your portfolio remains aligned with your long-term goals and current market conditions. As interest rates rise or fall, it's important to adjust your asset allocation accordingly to reflect the changing economic environment. Rebalancing your portfolio in response to rate changes. When interest rates change, the relative attractiveness of different asset classes may shift. For example, if rates rise, you might want to reduce your exposure to interest-sensitive assets, such as long-term bonds, and increase your holdings in sectors that perform better in rising rate environments, such as financials or commodities. Conversely, when interest rates fall, you might want to increase your exposure to bonds, particularly longer-term bonds, and growth-oriented stocks that benefit from low borrowing costs. Rebalancing ensures that your portfolio remains diversified and optimized for current economic conditions, staying agile during volatile periods. Interest rate changes can lead to market volatility, which can create both risks and opportunities. Being agile and responsive to these shifts will help you stay ahead of the curve. For instance, if you expect a rate hike to slow down the economy, you might consider reducing exposure to high-growth stocks and increasing allocations to more defensive sectors like utilities, healthcare, and consumer staples. Additionally, if interest rates are expected to remain low for an extended period, you may want to increase your exposure to growth stocks, as these companies often perform well in low-rate environments. By staying informed about the broader economic environment and adjusting your strategy accordingly, you can maximize your portfolio's potential during periods of rate volatility. 4. The importance of staying informed. Staying informed about economic developments and central bank policies is key to anticipating interest rate changes. Regularly monitoring reports from the Federal Reserve, inflation data, GDP growth, and employment figures will give you valuable insights into future rate hikes or cuts. Moreover, pay attention to the global economic landscape. Interest rates in major economies like the U.S., the Eurozone, or China can influence global markets and lead to indirect impacts on your investments. By staying up to date with economic news and central bank announcements, you can better anticipate shifts in interest rate trends and adapt your strategy accordingly. 5. The role of financial advisors and tools for rate forecasting. While understanding interest rate trends is essential, navigating them effectively often requires expert advice and the right tools. Financial advisors can offer personalized insights and recommendations based on your specific financial goals, risk tolerance, and time horizon. They can help you adjust your portfolio and make tax-efficient decisions in response to interest rate changes, ensuring that you're positioned for long-term success. Additionally, consider utilizing financial tools and software that provide real-time data on interest rates, economic trends, and market conditions. Many investment platforms offer tools that allow you to model the potential impact of interest rate changes on your portfolio, helping you make more informed decisions. 6. Planning for long-term success, positioning for future rate cycles. While managing your portfolio during interest rate changes is important in the short term, it's equally crucial to think about the long-term impact of these changes on your financial future. Interest rates are cyclical, and the economy moves in waves. Understanding how to navigate the various phases of the interest rate cycle will help you maintain a robust, resilient portfolio throughout your lifetime. By keeping a long-term perspective, you can focus on building a diversified portfolio that can withstand fluctuations in interest rates. This will help you stay on track with your long-term goals, such as funding your retirement, buying a home, or passing on wealth to future generations. Conclusion: staying ahead of interest rate trends for long-term growth. The impact of interest rate changes on your portfolio is undeniable, but with the right strategies in place, you can navigate these fluctuations with confidence. By staying informed, understanding the key economic indicators, and implementing proactive strategies such as diversification, rebalancing, and strategic asset allocation, you can manage your investments effectively in any interest rate environment. Interest rate changes may be beyond your control, but your ability to adjust your portfolio and make informed decisions is entirely in your hands. Stay agile, stay informed, and take charge of your financial future, ensuring that your portfolio continues to grow, no matter what happens with interest rates. Interest rate changes are one of the most significant factors influencing the performance of your portfolio. And as we've discussed, they impact nearly every asset class, from stocks and bonds to real estate and commodities. By understanding how interest rates work and how they affect various types of investments, you can develop a strategy that keeps your portfolio resilient in both rising and falling interest rate environments. The key takeaway from this audiobook is that interest rate changes are inevitable, but they don't have to be something to fear. Instead, they can become an opportunity for growth if you're prepared. As an investor, your ability to stay informed, adapt your strategy, and diversify your portfolio can help you weather rate fluctuations with confidence. By diversifying your investments, you ensure that no single asset class dominates your portfolio, thereby reducing the overall risk associated with interest rate changes. For example, while bonds may struggle in a rising rate environment, stocks, real estate, and commodities might benefit or be more resilient to such shifts. This approach allows you to protect your investments from volatility and make adjustments when necessary, keeping your financial goals on track. Furthermore, staying ahead of interest rate trends means actively monitoring key economic indicators like inflation, GDP growth, and employment data, which give you clues about whether rates are likely to rise or fall. The Federal Reserve's policies, in particular, are crucial to understand, as they have the power to significantly impact interest rates. Being proactive means you're not caught off guard by rate changes and can make informed decisions about reallocating your portfolio. Having a clear strategy in place, whether it's shortening the duration of bonds in a rising rate environment, favoring certain sectors like financials when rates increase, or adjusting stock allocations based on economic conditions, empowers you to respond intelligently. These strategic shifts will help you maximize returns while minimizing potential risks. Ultimately, the key to navigating interest rate changes with confidence is about understanding the broader economic landscape and taking control of your financial future. The more you know, the more confident you will be in your ability to adjust your strategy and make the right decisions for your portfolio. It's not about predicting every rate change, but rather preparing yourself to respond effectively when they happen. By staying adaptable, diversifying your investments, and keeping a long-term perspective, you can turn the challenges of interest rate changes into opportunities. So, as interest rates continue to evolve, remember that with the right knowledge and strategies, you can safeguard your wealth and continue to grow your investments, no matter what the future holds.